Doc, Sean Duncan here with SMD Consulting and Accounting. So I promised you I would explain a little bit of the importance of financial statements. I am not going to make you a bookkeeper. I am not going to make you an accountant. I just want you to know what you need to know and why they're important. So first, disclaimers. Okay, guys, so financial statements, they can be intimidating. They can be a pain in the rear. There can be tons of data, and it can be confusing. At their core, there are two statements that I really need you to pay attention to. Oh my gosh, there's so many other reports. There's two that I want you to know about. Profit and loss, also known as the income statement, and the balance sheet. The profit and loss is the one that you probably can just automatically, intuitively figure out in a lot of ways. It is essentially 3 lines. I know it looked like a lot more if you've ever seen one, but there's 3 lines. Revenue minus expenses equals net income. That's it. The details is what makes it confusing. There's types of revenue. You might have 7 different ways you can create revenue, 100 different ways. The expenses, oh my gosh, think of all the expense categories and rent and supplies and people and all the things that go with it. The complexity is in the detail, but it is ultimately 3 numbers. Now, there is one very common thing that I do want you to understand this variation, that it's 5 numbers. And this is important, so I'm going to teach you some magic language that you need to know the difference of. Revenue minus cost of sale, sometimes cost of goods sold, equals gross profit minus overhead or general and administrative expenses equals net income. Revenue, cost of sales, gross profit, overhead, net income. Now, the reason I'm explaining this is largely due to the difference between revenue, gross profit, and net income. Those 3 things have different mathematical values. It's algebra, nothing overly complex about it, but the terms mean something. And this is where people get into trouble, is they use the wrong word and it costs them money. I've seen it bankrupt people because they were using the wrong things and wrong terms in contracts and misunderstanding it. It sounds extreme to say it bankrupts them, but let me give you this example. And this was one from years ago. Business owner would give a bonus based on their sales guy's productivity. Cool. He meant to bonus on gross profit. And then he would give a 10%, 20%, whatever the bonus was on gross profit, because of course you want the sales guys selling something that's profitable. The challenge though is the sales guys had control of the costs to close the deal. He wrote the contract as 10%, 20%, whatever it was, of revenue, of sales. So the sales guys would go out there and go, well, I'm going to give discounts. I sold 1 million units. Well, here's the problem. If it's $1 per unit and it costs 80 cents per unit to make, you would hope to make your 20 cents, 20% margin. But if you give them a bonus based on the sales and you give them authority to tinker with the costs and all the things, well, they were giving discounts and selling the product for 70 cents instead of the standard dollar. The cost was still 80 cents. So on every unit, they would lose 10 cents. Well, who cares about 10 cents? They were making multi-unit sales. Now the owner is losing tons of money and still has to issue a bonus. He has to issue the bonus on the revenue, which makes him lose even more money. The term matters. You might choose to incentivize your employees. You might choose to incentivize yourself, other partners. Those magic words do mean something. Now, there's interchangeable words. Revenue can be top line. It can be gross revenue. And that's where the gross thing gets really irritating, but it is termed. Gross profit is almost always gross profit, and net income is almost always net income. The other term is bottom line. Totally different than EBITDA, different conversation from a different day, but similar. The expenses have their magic on where they go. What's in cost of sales? Typically direct costs. It's the vaccine cost and the vaccination revenue. Boom, 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 simple. Rent is an overhead because it doesn't change based on productivity. That's what I want you to know about that. Now, what's really cool too is if you are a bit of an analysis nerd like I am, you want to be able to understand trends. If you just do, this is really neat, because if you've ever used Excel, I think it's neat. Again, I'm a number nerd. So if you take your financial statements from QuickBooks and you drop them into an Excel spreadsheet, let's just say you take the last 3 years broken down by month. So I've got 36 columns and I do a trend line. I take revenue, gross profit, and net income, and I turn them into a trend line or turn them into a graph that shows the ups and downs of those 3 little lines. Now, here's the deal. If you look at 3 little lines and the top one's going way up, the middle one's going way up, and the bottom one's going flat, what does that mean? If your net income is 0 the whole time, but yet everything is growing, it means you're probably spending too much money. That means you probably have overhead costs that are out of control or growing. And congratulations, by the way, you are now a financial analyst. That's it. That's financial analysis. You're looking at something and go, why'd that happen? Sometimes you have this weird spike. Could be a typo. Visualization is really, really powerful because when you're staring at piles of numbers, it can get lost. Something as simple as dumping it into Excel and doing a basic little linear chart, oh my gosh, it's a lifesaver for just understanding where you're going, what trends there are. There's a lot of other charts that are useful. I've just found this one to be extremely simple and extremely powerful for a business owner, and you don't have to be CPA to look at it. If you look at it and still don't know, well, turn to your CPA, ask the question, ask your office manager, what's going on here? You become a business owner instead of just an employee hoping and praying that your business is profitable. So that's important. Now, the balance sheet. The balance sheet is where confusion happens. If you think of it like a season record in sports, the P&L is the win or loss of the game. That event, did you win or lose? You had revenue of 100,000, expenses of 80,000, 20,000. Congratulations, you scored more than the other team. That's a win or loss. The balance sheet is your season record. It's the accumulation of the results. That 20,000 increased your cash. Now, the balance sheet is also 3 lines. Assets minus liabilities equals equity. Just like with your house. If your house is worth 800,000, you owe 600,000, you have equity of 200,000. That is it. It is confusing because a lot of people don't analyze it. And we're not going to go into heavy analysis, but I do want you to understand its implications because there are some tax implications to it that we'll touch on lightly. But assets minus liabilities equals equity. Assets are anything that has value. Cash has value. Your furnitures and fixtures have value. If you have IP that you've created, it has value. Receivables have value. Things that are liabilities, it's when you owe money. It's payables. You still owe your credit card. You have a loan. Anything that you owe money back, that creates debt. Equity is just simply the algebraic result of the end of that. And there are transactions that can affect only the balance sheet that never hit your profit and loss statement. And this is where people's heads explode, and I'm not going to make your head explode today. But understanding that this is the accumulation. Think of it as the accumulation of wealth. And when you're wanting to take distributions and money from your company, you don't look at the P&L. You look over at the wealth and equity you have. Think of it this way. If you go to your bank and you want to do a home equity line of credit, how much are they going to allow you to take? They will allow you to take up to some percentage of the equity in your house as an additional loan because they don't want you upside down. You can't take more than you have as value. The same logic applies to your business. When you want to take money out of the company, you can take up to your equity in most rules. There are exceptions on taxes depending on entity type, but you can take up to that equity, typically tax-free, because it's kind of a return of the money that you've already paid taxes on. So knowing that statement, its single most important value for a lot of business owners is how much money can I take? That's equity. Now, there's a lot of rules when you have a multi-partner organization that there's a lot of allocations that are different and it gets a little fancy. You're going to get into things like how liquid are you? There's ratios called the current ratio that we can always cover if you guys are interested in those levels of details. But I want you to understand those 2 statements. And as a sister to the conversation I had about your EMR not being this piece of software, your EMR is showing you a lot of that revenue stuff. This is showing the picture of the health and wellness of your business. And here's the most important part of it all. The financial statements are for you to make management decisions. They are not for the CPA. They are not for the banker. They are not for the IRS. They're not for your investors. They're all going to want to see them. Their primary purpose has always been to give you information to understand the financial wellness of your business so that you can make a decision. It's why you run blood work. It's why you do MRIs. It's why you do x-rays. You need to see what's going on so that you can decide the next course of action. The financial statements are the blood work, the MRI, and the x-rays. They're the things that tell you the health, the wellness, the insights into what you need to do to make a decision going forward. Now, here's a soapbox pet peeve of mine that drives me completely bananas. Many CPAs do the financial statements so that it makes it easier for them to do the tax return. That makes sense. I mean, you want it to be easy, right? You don't want to pay them any more to cause more work. But here's the problem. When it's easy for them to do the tax return, it might not be useful to you for doing your business. Here's the most common example. So a little bit of accounting nerd. If you buy a piece of equipment for $50,000 and you're going to depreciate it, that piece of equipment is supposed to depreciate over 7 years, we're going to say. So you chop it up into 7 times 12, so 84 little parts, and you spread that out every single month. You drip a little expense onto your P&L, and it shows depreciation. The purpose is to match the expense over the period of time that it was generating or related to income and expenses. It matches expense with how it's generating revenue. So it's a matching thing. For example, if you pay for the vaccines in June and you don't use them to December, now your June looks terrible, but your December looks good. We want to try to match that up a little bit so you can have better insights into how you actually are being profitable. And that's the purpose of depreciation. However, the CPA that's only focused on the tax return doesn't care. Not that they're bad people, this is just for them. They're going to go, yeah, whatever, book it on December. And there's a rule that allows you to accelerate, write the whole thing off right now. Now, you want that $50,000 tax deduction. So if you put it in the books over 7 years, don't think you're cheating yourself. There's very specific rules that say, yes, you can put them in your books the correct way to give you management reports, spread it out, and then reconcile it on the tax return so you can still get your deduction. Hooray! You get the best of both worlds. You get a good management report and you get a massive $50,000 tax deduction right now. Now, granted, you won't get the deduction in the future years because you took it right now, but that's kind of cool. What the CPA will do that's focused only on taxes and go, yeah, I don't care about that management report stuff. I'm going to put all $50,000 on December as one shot because that will now make my tax return numbers look exactly like my bookkeeping numbers. So it's easy. Easy doesn't help you because if I drop $50,000 of expenses on a single month, now that month is all kinds of screwed up, just like my vaccine example. But boy, it's so much worse. Everything gets booked. This happens all the time. Many CPAs and tax preparers, EAs and otherwise, just throw expenses in December because they're only looking at it as a year and they're not trying to analyze. That's not what they were hired for. They were hired to do a tax return. So they do it, it reconciles, they move on, boom, they're out of there. But it doesn't help you. And when you are a practice owner, it's much more sophisticated. This is more than just grinding a return. You got something to grow and build here. There's real money involved. So just keep in mind, total soapbox, pet peeve of mine, even the tax forms know that practitioners are going to spread it out and do this acceleration. There's a specific form to reconcile that. There are lines that go, what was the book depreciation? What was the tax depreciation? Because the IRS even knows you're supposed to do it this way. But it's a little bit harder for the tax preparer to do, so a lot of them just skip it. So keep in mind, I want your financial statements to be useful to you. And there's all kinds of cool stuff out there in financial planning and analysis. It's really neat. You don't need to be a guru. I want you to know what the 3 categories, 5 on the P&L, really 3 on the balance sheet. I want you to know what the categories are. I want you to know the magic language so that you can make decisions. And then over time, you will determine what's important. You will decide what your financial analysis brain will be, or you'll retain somebody to help you with that to guide you on where it goes. So please, don't blow off bookkeeping. Bookkeeping is the MRI, X-ray, and blood work. You're not going to jump in there and do surgery without some information. We can't jump in there and help you save money on taxes if we don't have information too. So just know it's a critical function. Don't blow off the bookkeeping. It decides a lot. Thanks, guys.